think it's time to get this going. What's up, everybody? Good morning, good afternoon, good evening. My name is Kelly Kellum. Welcome to the BitLab Academy daily live stream every day, 10:30 a.m. Eastern Standard Time. Wherever you're at in the world, welcome to our community. Please go ahead and hit that like button, that subscribe button down below, ting that bell. Stay in the know, bridge that gap from beginner to pro. Whether you're a beginner or you're a pro, we've got the alpha here for you to help take you across that finish line, to help you get to success, to get to profits, and to keep them. Today, I am super excited because we have an excellent show lined up for you today. I've got somebody that I have so much incredible respect for in the space. And he comes from a wealth management background. And let's be honest, that's what we're all trying to get to: wealth in life, wealth in love, wealth in relationships, wealth in money, using these crypto markets, which are exploding, and they have such room. There's no real ceiling above them for the next 50 years or more, and we are getting in at the right time, and I'm glad to have you all here with us. Again, my name's Kelly Kellum. Please go ahead and give me a follow at that at symbol right there under my name, and make sure to follow all these socials on the bottom of this screen, at Academy BitLab on Twitter, at BitLab Academy on YouTube, and of course on Instagram at Academy BitLab. Before we jump into this, having a wonderful guest on, I just want to go ahead and point out that we have, I did this again. We have, there we go, right there. We're going to go ahead and make sure you're following this this Twitter profile right here. Make sure you're not following any imposters. Head over to our Instagram, which is right here, at Academy BitLab, and make sure you check out bitlabacademy.com because we have so much wonderful stuff going on there. We've got over 25 new courses coming very soon. We still have a number of great courses and lessons in there already. We have over 200 new lessons coming also, and we've got some great indicators here. And if you use right now, because the markets are exciting again, we decided to put a coupon code on there again to give everybody a discount. You can use bullish15 to get in 15% off, whether you want to do courses or the indicators or both. So check that out. So without any further ado, I'm going to go ahead and bring on our guest, who is none other than Mr. Caleb Franzen. How you doing, sir? How you feeling? What's going on? Thank you for being on the show.
Kelly, thank you for having me. I'm doing really well. It's a Friday. It's hard to complain. Markets are digesting the massive gains we've already had at the beginning of the year. So I think in a lot of ways, people are just kind of sitting on their hands, and so am I. So I'm excited for the discussion today, man. Let's get into it.
Yeah, and just before we continue on, I just want to shout out to everybody that's here, tuned in with us here in the BitLab Academy daily streams. We've only been doing this a week so far. We've already got such a core, strong community of people that tune in every day. I want to just ask, before we do continue on, I want to make sure everybody can see and everybody can hear as well as possible. So all the audio and video is good. If it is, please go ahead and give me a thumbs up in the chat. Also, let us know where you're tuned in from, so we see how far we're reaching around the world. And if you have any questions, any sticking points, any frustrations in the market, go ahead and put those in there, because as I said, even if we don't get to it in this stream, we're trying to do as best we can to give you all the content that you're asking for, that help you work through the sticking points that you're working through, and we're going to get you there together. So without any further ado, I'm going to throw it over to Caleb, and this is going to be the Caleb Franzen show today. And before we go any further, make sure to follow him, and he's going to bring it up at the very end as well. I have a link for his Twitter in the description below, but it is at Caleb Franzen, and you can also, there's also a link down there for his incredible newsletter that he does, which breaks down all these concepts. So, Caleb, there's so much going on in the market, and one of the things I've noticed since I've been in, especially in crypto the last 6 years, is how many people they get lost, especially early on, thinking every time they buy, the market drops, or every time they short, the market goes up, and they cannot figure out what's going on. They're reading RSI, they're reading stochastics, they're, whether they're doing it the proper way or not. There's all these other things I think early on we forget within the crypto ecosystem, being that these assets do not live in an echo chamber. They live in the context of broader markets, traditional assets, monetary policy. And I really want to just sort of highlight today, and I know we can't go into the 14 years worth of lessons that we need to really break it all down, but let's touch on it today as much as possible. some of these things people can look at the broader strokes so they can understand how to integrate this into their strategy when investing and trading in crypto?
Yeah, it's super, super important to have this holistic perspective when looking at individual assets, broader market dynamics. You can't make the kind of simple assumption that anything operates in a vacuum, even statistics, right? And so even for me, looking at technical analysis, statistical indicators, all this stuff is super important for me because it helps to kind of contextualize and tune out some of the noise that we're getting in the broader macro dynamics with the Fed, inflation, geopolitical risks, all that other stuff. So it's great to be able to objectively analyze statistical data, but we can't operate exclusively and solely on that data. We always need to be contextualizing against kind of the broader macro framework here. And so that's really why I named my business and my newsletter Cubic Analytics, is because I take this 3-pillar approach and nothing I do operates exclusively by itself. And so everything I do operates from a perspective of macro, the stock market, and Bitcoin. And there's a massive kind of commingling between those 3 dynamics. And so, I come from traditional finance, if you will. I have my bachelor's degree in economics and I studied finance in college as well. Took all the different accounting courses, this, that, and the other. Did banking internships, did wealth management internships, and then worked in banking for about 3 years professionally. And so, I can't shed that skin, right, of my prior background. So for me, I've tried to use that as much as I can as an asset to understanding market conditions with my academic and professional background. So yeah. Kelly, I can't hear you. You might be muted.
That's one of the, I live in New York City and, we get packages all day. I live on the first floor of we have a duplex. And so the delivery people tend to ring our bell when they want people on the other floor. So trying to mute it while you're talking to prevent that. But one of the things I love about your analysis is that you really contextualize and draw a lot of information, not only from a lot of those signals I was talking about before, whether it be moving averages, some key fibs, trend lines, and such, sure, but also drawing in, looking at what's going on. And right now is sort of a hot point, the hot topic, I should say, regarding what's going on with monetary policy in the U.S., what's going on with, are we going to go into recession? What's going on with all these broad sort of strokes. And there's certain things that people can use and understand looking at, this whole risk on, risk off approach. And so before we go any further, can you talk a little bit just about just contextualizing to throw the rope back for the beginners to bring them up to here on the same plane. First, what is risk on, risk off? And how does that sort of play out when we're looking at what's going on with market cycles and the cyclical nature of the flow of money within markets?
Yeah, this is one of my favorite questions, Kelly, because it really kind of underpins a lot of my overall approach to understanding markets. And so for me, risk on, risk off dynamics, I boil it down to a very simple variable, and that's monetary policy and the Fed. And so for me, everything starts from there. And so even in my 2023 outlook, I provided an updated perspective on that framework, which I really provided publicly in 2022. And really tried to focus on, green light, yellow light, and red light for risk and risk appetite. And so for me, all of that starts kind of with the Fed. And so instead of regurgitating it here, I'd love to just share my screen on this because this is directly from my 2023 market outlook. And if we just focus on this section, basically right here, I want to become overweight U.S. equities and dollar-denominated assets in periods of monetary stimulus. These periods are identified by falling/suppressed interest rates and an expanding Fed balance sheet and rising money supply, M2, and reserves. The yellow light here is going to be to shift towards caution as the Federal Reserve reduces their rate of asset purchases. So you might remember this is tapering, right? That was announced last November, and begin to transition into a period of monetary tightening. That was the transition process as we geared up into Q1 of 2022. These periods are identified by calculating the derivative or rate of change in monetary policy, right? So a reduction in the amount of stimulus. Finally, we want to become underweight US equities and dollar-denominated assets in periods of monetary tightening. These periods are identified by rising interest rates, a contracting Fed balance sheet, and declining money supply and reserves, right? So again, this very simple and basic framework that I've really been utilizing since 2016 with really good results, right? And it's super simple, super basic. It doesn't take a PhD in economics or someone who's even been super involved in macro and economics for too long to be able to understand this and actually implement it within their own portfolio. And generally speaking, I think it's going to allow you to move out of a market when conditions become unfavorable and get back into a market as things start to become more favorable. And with trading, investing, whatever the case is, it's always super important to set yourself up for success. Where, one thing I always like to say is, fighting the Fed is a lot like a goldfish trying to swim upstream. You're not going to be able to do it. So what we want to be is turn into a salmon and try to swim upstream. But even still, that's going to be very difficult, right? We're going to have to dodge bears that are trying to catch us coming out of the water. All this stuff is just super chaotic. So why not move with the stream, move with the current, have tailwinds in our back, and be able to just swim, glide, whatever the case is, along with the current, helping to move us faster downhill. And so for me, that's how I'm always going to approach things. So as we're talking about kind of overall risk on, risk off dynamics, again, this is why I just boil it always down back to the Fed and what is the Fed doing?
Yeah, I mean, I completely agree with you there. But what I know everybody's hungry for is you and I, we've got some nice jawlines. We might have a decent looking face, we're probably not the best looking, but what looks much better to everybody on these streams is looking at some charts and breaking things down. So I'm going to kind of let you run with it here and sort of work through some of the things that you see, some of the things you're watching. And I want to shout out to anybody that's watching live and stream right now, live here on this, the BitLab Academy YouTube channel, because this content is meant not only to be for today, January 20th, 2023, but it's meant also to be a bridge for you to watch at any point in the future. So we are going to take into context what's happening today, but this is also, if you look at the inverse for it, would be if we're at the top of a bull market, or if we're at the, basically different phases in the market. You can look at these signals as they are, or the inverse of as they are, for the different contexts and different situations in the market. So we're just going to go through some of these things. And again, wherever you're at, whatever stream you're watching it on, whether it's here at BitLab Academy or on Hit Network, follow along here. And again, don't worry if you're not watching it today, because all this is meant to be the concepts of how to engage with the market. So Caleb, take it away. Show us those beautiful charts.
Appreciate it, Kelly. And yeah, I, admittedly, I didn't do much at all preparation. We got on like 10, 15 minutes before, and I started pulling up some charts to get things ready. But I think, we're going to have a lot of value here. And so what I'd like to do first and foremost is start kind of from that high level perspective, just to illustrate the, kind of the magnitude of what we were just talking about as it pertains to Fed stimulus. And so what I want to share is this chart first, which is what we're looking at here in blue is reserves held by depository institutions or commercial banks in the United States. And in red, what I've done here is I've created a relative performance ratio comparing the S&P 500 high beta versus S&P 500 low volatility. And so for me, from my perspective, this ratio, it's SPHB divided by SPLV, allows us to get a gauge for risk appetite, because high beta is going to outperform low volatility in a bull market, and low volatility is going to outperform high beta during a bear market, right? So this relationship is super important. And what we can see is that
I'm going to pause you just for a moment.
Please.
Just because one of the things I've noticed as I was writing, working through doing all this training content for the BitLab Academy, the actual membership area, is, when I think I've taught something that's understood, one of the things, that we learned early on is when you think you've broken it down, you're only getting to the end level of the beginner's education. So can you just break down what you mean by high level beta and that sort of context? What does that mean for somebody that's never heard that term?
Sure. So high beta is something that's going to move by a larger magnitude than the broader market. So something that has a beta of 1 is going to move perfectly in line with the S&P 500 or the underlying index. Something with a beta of 2 is going to move twice as much as the S&P 500. So if the S&P 500 is up 1%, something with a beta of 2 is going to move up 2%. If the S&P 500 is down 2%, something like with a beta of 2 is going to be down 4%, right? And so if we just really quickly look at SPHB top holdings, let's just pull this up, right? So Carnival Corporation, AMD, Caesars Entertainment, Align Technologies, Meta, Royal Caribbean. So these are very volatile stocks, right? So you could essentially look at high beta equals high volatility, right? So that's kind of the way I kind of view it from a fundamental perspective.
Awesome.
Yeah, and thanks for keeping me honest here to explain it a little bit more. And so what I want to call out here is that as reserves rise in blue, we could see a very similar dynamic happening for high beta outperforming low volatility stocks. That's exactly what we would expect to see, because as reserves increase, that's a signal of more monetary stimulus entering the system. Conversely, as reserves peaked in August of 2014 and started to decline, what happened? High beta stocks started to underperform low volatility stocks, which is shown by this red relationship declining. We did get somewhat of a strange kind of outperformance of high beta versus low volatility during this period, even as reserves were declining. But we could see generally, right, that period didn't last for too long, and we got another massive kind of downside correction here. Now, what happened since COVID is the exact opposite. We had a massive increase in reserves in blue, massive monetary stimulus by a historic degree. And what happened? High beta drastically outperformed low volatility stocks during that period. What happened? Reserves peaked in November of 2021, right when the Federal Reserve announced that they were going to start tapering asset purchases. That's exactly, and what happened? High beta versus low volatility peaked and started to decline, and we've been declining since then, right? And so from a fundamental perspective, this helps us to quantifiably prove how liquidity dynamics, how Federal Reserve stimulus, how reserves in the commercial banking system help to create a strong undercurrent for high beta assets to outperform the broader market. And so why is this important, right? Why am I talking about stocks right now when this is going to mostly be a discussion about Bitcoin and crypto? Because Bitcoin and crypto are basically high beta stocks, right? They're high beta tech. People in traditional finance are really going to refer to crypto as fintech in a lot of ways. And there's a clear relationship between how something like the NASDAQ and Bitcoin have performed over the course of the last 12, 14 months or even longer, right? And so starting from this kind of broader framework now, I think it's a great kind of base to build on for the rest of the discussion, because again, I'm always going to kind of go back to this basic framework here, looking at what is the monetary policy environment that we're currently in, how is that impacting reserves, and therefore, with that understanding in mind, what do we know about how risk assets are going to perform in that environment? And so this chart that we just went over really helps us to illustrate and understand that dynamic. So Kelly, if you have any questions about that, I'm happy to kind of discuss it further, or we can just go straight into the next chart and really focus on Bitcoin specifically.
Well, I do see there's somebody, Hard Fork Crypto in chat asked Kelly Kellham. I'm not sure who that is, but Kelly Kellham, he asked, is there a website that shows beta coefficients between alts and Bitcoin or stocks and Bitcoin?
I don't necessarily know about that, but I'm curious
there is, and I can't remember what it's called right now. I'll research and put it, message it in here later. But there is a measurement of the correlation between stocks and Bitcoin that a lot of people use, trying to show how heavily correlated or uncorrelated it is. But that's a little bit, almost adjacent kind of to talking about high beta as it relates to Bitcoin.
Yeah, so that would be the correlation coefficient, which is something that I use very frequently. There's probably something on TradingView. I'm sure someone has coded some sort of beta calculation that you can actually measure. I know, like, for example, if you're just focused on stocks, if you're logging on to like Yahoo Finance or Fidelity or Schwab, whoever your broker is, they provide beta data. Basically to evaluate what the beta of any individual security or ETF is relative to the broader market. So that data is certainly accessible. For crypto, I'm guessing you might need to go on TradingView and try to find some sort of indicator that someone's already produced.
Well, no, that's wonderful. I appreciate you sharing that. One of the things that we've talked about this before, on my podcast series, Crypto Answered. For anybody that's not tuning in there, tune in because I have Caleb on. He's almost a resident there. He's on so regularly. We always have great conversations there every Thursday through my Twitter. But we talk. I've seen you post a number of charts in the kind of recent past, and this is relevant at any phase of the market cycle, everybody. And I pointed out many times on the stream with everybody here that if you've tuned in, if you haven't, go to the playlist, watch up the past streams. They're all evergreen. They apply to any part of the market. But I'm really big on understanding where we're at in the market cycle. And then I really try to break down to everybody that you always need to have what I call a 3-cycle strategy, meaning every time you look at a chart, look at the macro, then break it down to the midterm, and then you can break it down to the micro, and whatever micro is for you, whether it's a 4-hour, 1 hour, 24-minute, that's all going to depend on your independent strategy or time horizon. But one of the things that you pointed out is the VIX, and I think that's kind of ties in similarly to what you were just talking about with high beta coefficients, volatility, because the VIX is a measurement of it's a volatility index. Would you say is this similar at all to, for instance, when people use Bollinger Bands on Bitcoin and they look at the Bollinger Bands, basically width percentile or anything like that? And if not, that's okay. I just want to clarify that for people that might draw a correlation, but then also, how are you using the VIX looking at traditional stocks when you're also looking at Bitcoin for potential investment or trade opportunities?
Awesome question. I've been really focused on the VIX since mid 2022. I mean, it's always something that I'm keeping my pulse and radar on, but I think I really kind of discovered somewhat of a effective strategy in mid 2022. So I'm happy to share that with the audience today because it's something I kind of, go ahead.
What is the VIX? Tell them
the
what the VIX is. This thing's great. I never used that until I saw you use it, and it's phenomenal.
So the VIX is just the hyphenated version, if you will, or not the hyphenated version, but the short version for the CBOE Market Volatility Index. And so what this does is it's a constant measurement of how much volatility investors and traders are expecting to see in the S&P 500 over the next, I think it's 60 days or 30 days, something like that. And so there's some kind of weird math that you can get into to essentially calculate the implied move of the S&P 500 on a daily basis by dividing the VIX by something like 16 or something like that, right? We don't need to get into all of that. But essentially, as market fear starts to rise, the VIX is going to rise. And as complacency starts to come into the market, as greed starts to take over fear, typically that's shown by the VIX falling, right? So a lot of people like to look at something like the fear and greed index. The fear and greed index is essentially the VIX in a lot of different ways, right? The VIX is a major component of the fear and greed index. And so it also looks at some other different variables as well on top of that. But it's important to know, right? Like everyone pretty much knows the fear and greed index, even if they haven't necessarily heard of the VIX or really spent too much time analyzing it. And so one thing that, that we could do here, let me share my screen on this. So what we're looking at right now is the VIX, basically going back to October, November of 2021. And so the thing that I started to notice is that we got these big spikes here in the VIX throughout the year. These retracements back down basically to this $20 level. And so what I started to notice is that it was an effective strategy to start to sell risk assets when the VIX got below 20 and start to buy them when the VIX got above 30, right? So you want to buy when there's blood in the streets. That's a saying and phrase that people have heard very often. And you want to sell when people start to get too confident, when greed starts to come back into the market.
So in a way, this is a technical measurement of confidence in the market. And the more confidence, the more risk they're willing to take on.
Yeah, I think that's a good way to put it. Yeah, for sure. And so what we've been seeing just recently now is that the VIX crossed back below 20. The VIX is down 4.5% today, trading below 20. So again, I think this might be another positive development or signal, if you will, that we should start to sell and reduce our exposure to risk assets. Because right now there's a lot of complacency. Greed is coming back into the market as we look at something like the fear and greed index. And so I think that's important to kind of have on our radar at the present moment. I want to try to find this exchange that I had with somebody on Twitter yesterday, because what I did is I showed the relationship between the VIX and the S&P 500. Let me just pull this up really quick, Kelly, but I'm happy to take any question about the VIX if you still have any.
No, I just think it's great, for everybody to learn about this, because, one of the things I'm really trying to impress on people as they enter the market, the earlier in your journey investing, especially if your journey starts in investing with crypto, to not only, a lot of people say this talking about market trends, when in doubt, zoom out. But in truth, that doesn't only apply to looking at charts. You need to zoom out from the market you're in to look at the broader context of other assets, other asset classes, gold, what's happening with housing prices, what's happening with monetary policy, and the broader scope you can get to have a deeper understanding of the general trend of global markets. You have a better indicator of what's happening. And that's really what I really want people to gather from all this. And the VIX, I feel like, is a simplified tool that a lot of people, if they can't look at everything, to just get at least a general grasp of where the confidence is in the market.
Yeah, exactly. And so the chart that we're looking at right here, what we've done is we're looking at the VIX in red and the S&P 500 in blue. This bottom white line is 20, this top white line is 30, right? So again, let's think back to the strategy that I outlined. You want to sell risk assets when the VIX gets below 20, and you want to buy them back when the VIX gets above 30. And so when we look here, the VIX got above 30 here. What happened to the S&P 500 thereafter? We went on a pretty solid rally. If I remember correct, this was about a 10% gain. Again, the VIX gets above 30 here, we get this massive rally once again. What happens? The VIX gets below 20 right here. What happens to the S&P 500? Crashes, gets back above 30. We start to get another little rally through here, right? So these kind of contra indicators, the VIX is back above 30 here. Hey, that's the perfect bottom on the S&P 500, and we rallied back up. The VIX gets below 20. Hey, that was the perfect peak in the S&P 500, and then we rolled back over. The VIX gets above 30 once again. Hey, look, the S&P 500 bottomed in that same pocket zone, right? So once again, I don't know if this indicator is going, or this strategy is going to continue to work in 2023, but clearly, unequivocally, it worked with extreme effectiveness in 2022. And so again, I think you're absolutely right. The VIX is something that's very simple that we can look at, something very simple that we can keep a pulse on, and knowing whether or not it's above 30 or below 20 is a very simple thing. It takes you 5 seconds in the morning to check that out to essentially gauge where we are in the broader market. And so I think that's another great thing that people should have kind of on their radar. Again, it could stop working. Maybe I'm jinxing it now that I continue to kind of pound the table on it, and now it's no longer going to be effective. But we'll see how it runs. And I think it's definitely, regardless, one thing to have on our radar for sure.
No, that's excellent. I always love talking to you. I feel like I know a great deal about crypto, blockchain, trading, investing, and then I sit down with you, and every time I talk to you, I always mention this. I feel like I need to pull out a notepad, and I want everybody to realize that no matter what level you are, no matter how far along you are on your journey, it's always important to surround yourself with people that are strong in areas that you can grow into. I mean, even Tiger Woods at the top of his game, he had a coach. Okay. And I'm not saying Caleb's my coach, but everybody around us, whether we know it or not, is a coach to some extent, because we grow in to basically the sum average of the 7 or 8 people we spend most of our time with. So it pays to be very aware of who you're spending your time with. That could be in life, hanging out, but it also is on this digital space, on Twitter, who you're following, why you're going down a 40-minute TikTok trail rather than watching, splitting it up between 20 minutes of investing knowledge, or here on BitLab Academy. So I always love talking to you, Caleb. And again, thank you for coming on. We're still going for a while. I just wanted to shout that out, and shout out everybody in the audience. Thank you for being here. Thank you for tuning in. It's going to pay you dividends to be here after such an endeavored bear market that was just a year of red, cascading liquidations. It seemed like there's no trust left, but it's amazing to see this foundation of people that are still here. And you're going to be the OGs in a matter of months when the market starts going up. You're not the person that bought at the top anymore, and that's important. But what I want to throw it to now is utilizing what's going on today, but I also want to make sure we utilize any past signals or situational context that you can think of or that you've seen on the charts of right now, everybody wants to know, have we bottomed? So looking outside of the Bitcoin chart, what sort of things, whether it was in the previous market top or not, and also the context of today, today's January 20th, 2023. What are the things you're looking at outside of the charts? Because all these bullish on-chain metrics, we've broken past the 200-day. We're up there. We're above the short-term holder cost basis. All this technical data within Bitcoin. But what are you looking at with what's going on with the stock market, or one or two things that people can look at to use context outside of this asset class to give deeper context to likelihoods? Because we very well could have bottomed, but we cannot ignore broader signals and broader data that may be conflicting with that. So what are you looking at in this sort of context?
Totally agree, Kelly. And full transparency, I don't think that we've bottomed personally. And I'm happy to get into the reasons for why that's the case. Let's zoom out here really quick. And let's not talk about Bitcoin or anything like that right now, but let's just talk more broadly speaking about risk assets and how they perform relative to some key economic data. And so the chart that I'm about to show right now, I think, is probably one of the most important charts that people should have on their radar as it pertains to economic data, excluding the Fed. This is something I started sharing at some point last year. I can't remember if it was probably between July and September. Either way, it continues to evolve in the manner that I expected it to. And unfortunately, that isn't necessarily good for risk assets. And I'm definitely going to be curious to see how this continues to evolve. So let's go ahead and jump straight into it. Share, there we go. So what we're looking at right here in red is the year-over-year percent change in the unemployment rate, or excuse me, that's in blue. We're looking at the year-over-year percent change in the unemployment rate. And then in red, we're looking at the year-over-year percent change in the NASDAQ. And so let's think about this, right? Right now, we have the unemployment rate at 3.5% as of the December data. And so if I remember correct, this indicator right now in blue is showing basically a negative 10% decline in the unemployment rate, which basically means that this time last year, so December 2021, essentially, the unemployment rate was about 3.8 or 3.9%. And that's exactly what it was. So we went from 3.9% in December of 2021 to 3.5% in December of 2022. But one thing that I really want to highlight here is this rate of change, right? At one point, the year-over-year decline in the unemployment rate was like negative 60%, right? We went from basically negative 14, negative 15% to negative 8, negative 9%. That's a 40% decline or 60% decline, right? Relative to where we were. But what we're seeing right now is this kind of reacceleration in the rate of change in the unemployment rate. And what we can see historically is that as this blue line starts to consistently grind higher, the year-over-year percent change in the NASDAQ starts to give back its gains and actually flip negative. So the NASDAQ starts to fall on a year-over-year basis between this red line, or excuse me, between this below this black line. Same thing happened. So this is going back to 1990. Right? Same thing happened in 2000, 2001. That unemployment rate starts to climb higher, get above zero. What happens to the NASDAQ? It plummets. Look at 2007, 2008. The year-over-year percent change in the unemployment rate flips positive right here. What happens to the NASDAQ? It plummets. Same thing. COVID was an anomaly, right? I want to zoom out from that entirely because this spike had never been seen before. We'd never had a 200 and a 300% increase in the unemployment rate ever in history, maybe except for the Great Depression.
Right. That was literally only because the entire country was shut down and then everybody went back to work. So it's a false, not a false positive, but just false data. But so tying this into what's going on right now, everybody's, arguing a bit, I don't want to say ignorantly, but not fully informed about this idea of a recession, thinking that because the market's down, they're saying, what do you mean? How can you say we're not in a recession? And this ties directly to what you're saying here about this key metric that is sort of a part of the whole context of what a recession is, which is unemployment. And this is why I think, right now we're just now starting to see these layoffs at Alphabet, these layoffs at Goldman Sachs. I mean, all these, there's a lot of major companies that are doing the layoffs. And then what happens, as bad as markets may feel like they've been, well, then what happens when you start having the percentage of people being unemployed go up? it's directly tied to what we talk about when we're trading in markets, liquidity. You have less liquidity being spent from consumers, and then you have further reduction of workforce, and then you have dropping of prices and dropping of what do you call it, profits and capital gain, all the things that drive markets lower. And so I think this is important because, and I wanted to do this show today. And again, whatever time you're watching this is directly related to any part of the market cycle. These numbers and this data is important because it gives you an idea. As much as it looks like we've bottomed on Bitcoin, there is huge economic signs that cannot be ignored, which are leading, because it's going to have an effect down the line of what happens in the markets. And this is why a lot of people are saying it's going to be sometime in Q2, maybe Q3, that the recession really basically becomes pervasive in our economy. But with that being said, we very well could have a midterm bull run between now and the next month or two. But we need to look at all this data and use what all of us that have made profits consistently had to get over the fact of losing money in markets always comes from lack of risk management. So this data gives us those tools so that we can use positive risk management. But one of the other things I wanted to highlight, and I love that you said this, I don't know, months ago, and it's stuck with me in my head, and it just points to something I think everybody needs to be aware of. And even if you think you're aware of it, take a moment and you sit down for 5 minutes and write out what's your risk tolerance and what's your time horizon for your investing. Because one of the things you said, Caleb, was was it under 40 that you should always be a net buyer? So I want you to talk a little bit about that, because I think it might be confusing when taken out of context, because net buyer doesn't necessarily mean you're always buying Bitcoin. Net buyer means addressing what assets to buy and when, but you should always be accumulating. But then also, if somebody's 70, maybe there's a different strategy there. And that's why the time horizon is important. So if you could just elaborate on that and how that relates to people's strategies in the market.
Sure. So let me start by saying this, which is that at the end of the day, we're all going to be retired at some point, hopefully, and we want to be able to live a comfortable retirement, right? And hopefully the sooner we can retire, the better, because we don't want to work. We want to be able to enjoy the fruits of our labor that we had when we were 20, 30, 40, etc., in order to enjoy our old age comfortably. And we don't want to be stressed about finances or not being able to consume or worrying about how we're going to pay our rent or our mortgage that month because we don't have enough assets to drain in our retirement, right? So our nest egg in a lot of ways is built around our wealth, because at some point we're not going to be working and having direct income. And so we need to tap into our wealth for that income in our old age. So from my perspective, everything, I'm 27 years old. I worked in the wealth management industry for some time. I worked in banking for some time. And now I'm really kind of doing my own thing, right? But at the end of the day, what I do know is that the Federal Reserve over time is always going to default towards providing monetary stimulus, to lower interest rates, and to suppress the value of the dollar, to debase the currency, right? And so whether or not that creates some sort of credit crisis or catastrophe from a kind of overall US perspective is certainly up for debate, but we haven't seen that yet. And so what we do know is that over time, the value of the dollar is likely to decrease. And so when the value of what you're basing the price of everything else on, when the value of that single asset like the dollar is decreasing, theoretically, the price of everything else should go up. The same is true with assets. Assets at the end of the day are just like any other kind of consumer good, in my view. And so from my perspective, over time, we should always have strong tailwinds for asset prices to rise, whether that's bonds, real estate, stocks, crypto, whatever the case is. On the aggregate, asset prices have tailwinds to rise as the value of the dollar declines. Very simple idea. And so for me, I really boil that down. When asset prices decline, that's a sign for me as a long-term investor, hey, risk premium is now rising in my favor. The equity premium is now rising in my favor. If you look at instances where the S&P 500 declines by 20% or 30%, the forward-looking returns thereafter are significantly stronger than any other time, right? And so that's a moment to be opportunistic. And so for me, right, I do say this, if you're basically under the age of 40, you know, you could change that around 45, 35, 47, who cares? The point is the same. You should always be a net buyer of assets for any given year, because we generally know the playbook of, from a macro perspective, what's happening with monetary policy and the value of the dollar. And so we don't want to be left in the dust. So for me, if that's $100 a month, $1,000 a month, some people are super rich and they could do $5,000 to $10,000 a month. We should always be dollar cost averaging and buying high conviction long-term assets that we want to hold in our portfolio, right? So whether that's something like Google, Nvidia, SPGI, some of these different stocks, right? Or crypto, or just having a well-balanced, diversified portfolio. Maybe you're saying, hey, all right, I want 20% of my portfolio in crypto. I want 40% in the stock market. I want 20%, you know, you can figure out those allocations and figure out how you want to play it. And so for me, like I say, I want to be a net buyer of assets for any given year. And so for me, what does that mean? I can certainly sell assets at a given point with the intention of reallocating that money back into the market or shifting my overall portfolio structure and allocation. And so for me, that's super important. I can certainly become more defensive in certain moments, more aggressive in other moments. Either way, what I do know is that over the long run, I want to own assets because I have a very high conviction that they're going to appreciate in value as the dollar loses value over time.
Man, I love hearing you talk. And shout out to the investing bros in the chat and all the mods as well. Really appreciate everybody being here and love having Caleb here sharing this. This is such high alpha for just having a context of even just stepping up to the plate to approach the market, because this is very important. And even with, I want to point out also this idea of diversification, because you just touched on it a bit there. Even if you're somebody like me, and I'm not saying anybody else should do this. This is not financial advice. This is, I have very high conviction in crypto. I have very small, I don't even consider it exposure. I have very small exposure to some other assets, but for the most part, I'm all in on crypto. But what I want to point out about it is, even being all in on crypto or 95% in, I don't just have Bitcoin and a bunch of layer one smart contract solution assets. I look at the broader context of the market and I try to identify through, fundamental analysis using quantitative and qualitative analysis. I went over that in one of the last videos here on BitLab. If you haven't looked at that yet, understanding the teams of projects, understanding the industry that they're in, understanding not only that asset, but the growth, the growth projections for those specific industries. And I've diversified my portfolio of crypto assets that touches on a number of different fields, whether it be long-term storage, investment like Bitcoin, significant allocation, because that is considered the safest bet within the crypto ecosystem. I don't even consider it a crypto. It's so far separated from the rest of the pack. But then I also do have smart contract platforms, but I have it split between a few. But that entire allocation is for DeFi, for instance, is split between Ethereum, Cardano, and a few others, going down how much my allocation is based on how large the market cap is for those. Because the more risky it is, the smaller my allocation is. And then when I go into gaming or something, of that effect, or something that's also very, very far down the coin market cap list, showing smaller market caps, less liquidity in those assets, then I have smaller percentages. There's some assets I have, between 0.5% and 1% of my portfolio. And you might ask, well, that's never going to amount to anything in your portfolio if you don't have a significant chunk. Well, I beg to differ. There's assets I've had in the last bull run that I had less than half a percentage, and they, as Wendy O calls it, the moon bag. And then when they do take off, you get those, they end up being 20% of your portfolio. And then what do? You take profits into the strength of the market, not buying at the tops and selling at the bottom, but selling into profit and buying into other people's loss. And that's sort of, I'm curious what your thoughts are on that in terms of your approach to crypto, and how, if you just allocating sort of a diversification sort of strategy to your crypto portfolio. Those were my thoughts on my sort of approach, and I'm curious to hear if there's any similarities or differences, or certain areas that you're kind of focusing on going into this next bull market.
Yeah, so I really appreciate the things that you just said, and in a lot of ways I would agree. But my main disagreement is this, is that if you look at basically like the relationship between Bitcoin and something like the total three, right? So that's total crypto market cap, excluding Bitcoin and Ethereum. So basically the altcoin ecosystem. If you compare Bitcoin versus the altcoin ecosystem, they move in lockstep pretty much, right? From a directional perspective. And so the magnitude of the gains or losses for altcoins is certainly going to be different than the magnitude of gains and losses for Bitcoin, right? As you diagnosed, Bitcoin is considered to be the safest one. And so risk is always going to be congruent to returns. And so when you have altcoins that are significantly more risky, investors are expecting to be compensated for that risk via higher returns. However, when we look at something like the stock market, more broadly speaking, we look at sector or industry groups. When we compare semiconductors versus energy stocks versus utilities versus industrials versus technology, each of these sectors is going to have significantly different performance, both on a short, medium, and long-term basis. And so with the stock market, I really feel like there actually is some opportunity for diversification, much more so from a directional perspective, much more so than you'll get in crypto overall. And so it makes perfect sense to me why investors, move further out onto the risk spectrum within crypto and start to get into different layer ones, DeFi projects, gaming, et cetera, right? There's a lot of exciting technology that's happening there. I typically kind of stay out of that from an investment standpoint, but looking at it from a trading standpoint, I was playing some alts in 2022. I certainly didn't sell soon enough. In 2021, I certainly didn't sell soon enough in 2022. So you give back a lot of those gains. Some things you sell for a loss, right? It is what it is. But yeah, that's kind of my general thoughts there is from an overall perspective, there isn't too much, I see less value in diversification within crypto than I do in for diversification in something like the traditional markets, if you will.
No, I mean, see, that's one of the reasons why I think it's so great to talk to different people. And I want everybody in chat to also be aware of this. My strategy being different from Caleb's doesn't make mine wrong and his right, and his strategy versus compared to mine doesn't make his wrong and mine right. Everything has to do with being aware of what your risk tolerance level is, what you're comfortable, not only your what you expect your risk tolerance to be, what is it really when you're looking at a chart and you're seeing price action happen? And if all of it was lost, how does that affect you? And my time horizon, my approach. It's important to have these discussions. Tune into these sort of streams here with different voices, and go into Twitter Spaces. There's so much incredible alpha on Twitter. In fact, people that aren't in the crypto space, they kind of laugh at how much I'm on Twitter, and I understand it. Before a year ago, when I was working professionally in crypto, I've been in crypto since 2016, but before I started becoming more of a face doing these things publicly, I wasn't using Twitter at all. And I literally, the only thing I do on Twitter is crypto Twitter. And you and I, Caleb, we've both built quite a nice following in a year just by sharing our thoughts, asking different people's approaches, and I've gained so much knowledge. I feel like I've gotten, I don't want to call it a master's in crypto, but there's so much exposure to different viewpoints and stuff. So I think that's beautiful. But what I want to do as we wrap this out, we probably got another 7 minutes or so before we do some closeout. I do want to shout out everybody that's here. I really appreciate it. If you haven't yet, please hit that like button, hit that subscribe. If this is your first time on the channel, ting that bell. But because this is something I want everybody to be able to view at any point in the market, I'd like, if you could, even if you're not prepared, I know you can do it in a flash because you are a professional analyst and you're quite articulate. What was there any sort of leading signs in whether it was 2017 or 2022, 2021, 2022, the breakdowns going from the bull market to the bear market in crypto? Was there any signs in any of the monetary policy or traditional assets or the VIX or anything that people can utilize going into this next bull run that will come at some point, whether we've bottomed or not? There will be another bull market. So how do we prepare in that bull market, looking at these, a couple of these signs and signals that could forecast that to help get us out of the market in time?
Okay, so I want to answer this pretty quick because I think my answer is very simple. And then I have two super important Bitcoin charts. So guys, if you're watching this right now, drop a like, send this to a friend, because we're going to go over really quick 2 really important Bitcoin charts I think everyone should see. Going back to your initial question, watch the Fed. What happened in December of 2018? They started to really forecast to the market that in 2018, they were going to be reducing the size of their balance sheet. Everything peaked, right, in 2017, at the end of 2017, including traditional markets. We got a lot of volatility in 2018. What happened in the lows of 2018? After consistent years of steady rate hikes, the Fed finally paused in December of 2018, even though they were still doing balance sheet runoff. Everything bottomed, everything went up, including Bitcoin, stocks, even bonds, right? Everything went up after December 2018. What happened in March of 2020? Neil Kashkari comes out and says that they are going to provide infinite support to the financial system and the banking system. What happened? Markets bottomed literally that day or the next day, ripped higher. What happened in November of 2021? The Federal Reserve announces that they're going to start tapering their asset purchases, removing the amount of liquidity that they were providing to the market. What happened thereafter? Everything peaked, right? So all we need to do, you can really just tune out the indicators. All you really need to do is watch the Fed. And so I know it's, again, super boring, but it goes back to what we were talking about at the beginning of this conversation. What's my framework? What the hell is the Fed doing? That's all you need to know. And then you can have a perfect diagnosis for risk appetite in the market going forward. Okay. That's what I have to say about that.
I want to. I know for 1 second, because that was so great. And before you get into these Bitcoin charts, I've shared mine on this channel before, but do you have a preferred Fed calendar or economic calendar that you should check in with regularly, or are you just broadly aware of it because you're in the markets all the time?
It's a little bit of both. One thing that I'll always check, let me just share my screen on this. Market Watch has a great kind of economic calendar. So, I mean, we could see here, each of the individual reports, as well as what the median forecast was and the prior data. And so we can even look going forward in the next week, right? So we're going to get the S&P 500 or S&P US manufacturing PMI data and the services PMI data. On Thursday, we're going to get GDP for Q4. Friday, we're going to be getting PCE data. So we can see all of this, as well as it doesn't look like they've provided median estimates quite just yet, but all the prior data, right? And so this is a great way to just easily have convenience for what data is coming into the market.
Oh, that's great. Thanks for that.
With Fed stuff, I'm pretty much in tune with that. And there's some great accounts I follow on Twitter who are kind of providing, live quotes and things from different press conferences and speeches that different Fed officials are giving. So just being on Twitter, I get a pretty good exposure to different Fed things that are happening. What I want to share here as we zoom out, right? This is, if you're watching this 2 months from now, this is still going to provide value for you because it's a very slow moving indicator. But what we're looking at is the price of Bitcoin, monthly candles. What I've added here in the lower bound is something called the Williams % R oscillator. And we won't get into the specifics of what it is or how it's necessarily calculated. Check it out. It's very simple, actually. But what we're looking at here is the 12-month Williams % R oscillator. So what this does is it allows us to evaluate where price is relative to a 12-month or a 1-year trend. That's super, super important. When we get below this lower bound, that's considered to be oversold. When we get above the upper bound, that's considered to be overbought. And so what's the trend here? Up and to the right. And so typically when something is trending up and to the right and it becomes oversold, historically, that's probably a pretty good idea to start perking your ears up, to start dollar cost averaging or buying at a discounted price if you expect that trend to continue. And so let's back test this. Every time we've gotten below this oversold range, started right here. Hey, look, that's a Bitcoin bottoming process. What happened right here? Hey, look, this is a Bitcoin bottoming process. Hey, look, this is a Bitcoin bottoming process. What are we in right now? We're still in that oversold criteria. We haven't crossed out of it. Look at this. Every time we've left this oversold zone, I've denoted those in red. The lows are in and we've continued to trend higher, essentially entering a new bull market. Where are we right now? We're at negative 82.5 basically. Once we cross above negative 80, that means that we've left that oversold area. And so for me, again, this is why I'm not necessarily confident that the lows are in, because we haven't gotten confirmation from this signal yet. But one thing that I've been sharing on Twitter since I started posting this basically in June of 2022, when we crossed below this level, is that we're in this is always so hard for me to say. We're in an accumulation zone. There we go. We're in this accumulation zone right now, and we could leave this. It may fail on the next time. We certainly don't know, but this is something that we should definitely have on our radar. We can edit this. So I've done this a couple different times as well. I also like to look at the 18-month. Why 18? Hey, that's a year and a half. Again, basically the same indicator, right? it lags maybe a little bit more, which we would expect to see. But again, this is going to provide additional context and confirmation as to, hey, have we left the bear market? Still, with this indicator, we're not quite there yet.
I want to point out with this too, for everybody out there. I know early in my journey, and I'm sure you went through this as well, Caleb, at some point, unless you're just the perfect investor. But you know, when you start getting into investing and trading, there's this need to feel like you caught 100% of the move. And you can see here when you zoom out, not looking at a 5-minute candle or even a daily, you can see that by using these sort of broader, longer term confirmations, if you're patient with these and trade longer, especially for early investors, focus on the macro. And once you master that throughout a cycle, then you can break it down and start getting smaller. Because if you waited for this, okay, yeah, maybe you missed, a 30 or 50% move at low levels, but then you're getting with not only the confirmation, but with a conservative approach that has proven results for the rest of the macro trend, that just by following the signal, you're basically not taking any huge loss whatsoever because you're conservatively moving in and out of the market.
Yeah, exactly. And I mean, look at this signal that happened here, right? We're looking at the 18 months of the 1.5 year trend. This whole area was, a negative 27% decline from the peak in that zone to the low in that zone before we really started to move higher. And so again, yeah, you're not going to catch a falling knife, a perfect bottom, but what this does allow you to do is to identify, again, an accumulation zone. And that's what's really important, especially as a long-term investor. We're not looking to do a swing trade here or a day trade. This is a multi-month, if not a year-long plus indicator, right? So again, that's why we're looking at the 12-month, that's 1 year. That's why we're looking at the 18-month, that's a year and a half. This provides long-term signal amidst a lot of noise.
So we're gonna have to do one more chart. We're gonna do the speed round here, and then I want to make sure everybody gets your info before we wrap out, because we're gonna be wrapping out in about 3 or 4 minutes. So here, this is a wrap up monster chart here, baby.
Perfect. So what we're looking at here in the top is Bitcoin divided by the S&P 500. So this is tying in crypto and traditional markets. And what we can see here is a very clear bullish RSI divergence, right? So we made lower lows in terms of price, but we made a higher low in terms of the RSI. So I was calling this out a little bit late, unfortunately. It was before I recognized that this was happening. But look at the RSI right now. We're way above even where we were back at that top in November of 2021, October 2021. So it'll be interesting to see where this goes. I've also added the 200-day moving average cloud on top of this. We're trading right above that right now. So that's super important for me. As long as we stay above that 200-day moving average cloud, to me, that means that risk reward is skewed for Bitcoin relative to the S&P 500. So that's a very interesting action, right? We got rejected on this level multiple times back in December 2021, back in March of 2022, at the end of March of 2022. We're breaking above it for the first time. So this is a lot of signal right here. Guys, this was such a pleasure to come on, Kelly. I really appreciate it. You hit me up a couple days ago to do this. This was fantastic. Check me out on Twitter, 100%. I'm posting so much data and research on here. Of course, here we go. I haven't done much posting today.
Let me just point this out. I thought I posted a lot, and I went on Social Blade and looked at my account and a couple other people's. I looked at Caleb's account. I had done like 200 posts in a month, and he had like 1,800 posts in the month.
That's because
a lot of content. It's great.
That's because I reply to every single person in the comments. So if you guys have any questions, I'm literally an open book. Hit me up. If there's a chart that I posted you're not quite sure about, just ask. I'm always going to answer. And then finally, check me out on Substack. Right now, guys, I'm running a free trial for my premium research, but I also do a free weekly newsletter. So again, Cubic Analytics. I take this 3-pillar approach, analyzing macro, the stock market, and Bitcoin. So there's going to be something for you in there, even if you only care about Bitcoin. If you only care about macro, fine, I have macro stuff in there. If you care about all three, perfect. Come join the fun. It's a free newsletter. And right now I'm running a free 7-day trial. So check that out. And Kelly, this was such a blast, man. Thank you so much for having me. Hopefully we can do this again, man. This was a great time.
We'll absolutely do it again. Maybe we'll get you on some sort of quarterly schedule, or maybe every few weeks. Doesn't matter. I always love talking to you. Everybody, give this man a follow if you haven't. Thank you, everybody that's tuned in. The whole focus of this stream of this, I don't want to call it a lesson, but this engagement with you all is to lend our experience and other people's experience to help you zoom out and take in the data. The data is available for you. And as I said in yesterday's stream, whether it's 1 hour a month, 1 hour a week, 1 hour a day, or 1 hour, every other hour, the more data you take in and honestly analyze, the more tools you have at your disposal to, one, you're gaining better understanding, you're gaining knowledge about how to interpret that data, and three, you're able to then apply that knowledge and that data to your investment trade decisions, investment and trade decisions. That's what I had to say. So everybody, again, thank you, Caleb, for being here. We're going to go ahead and wrap this out. I want to say thank you for everybody that's been here in chat. Really appreciate you all. Please hit that like button, hit that subscribe button, ting that bell. We're going to be heading over to BitBoy Crypto now to get some news and some personality there. And we're also, if you're watching this on the Hit Network, if you haven't yet, check out Hit Network. But if you're watching this on the Hit Network, come check us out at all these socials below for BitLab Academy. My name's been Kelly Kellum, or is Kelly Kellum. I hope you all have a wonderful day, and we will see you in the next video. Over and out, everybody. Thank you for watching.